Hi, I'm James Robinson. I manage money for a living. My company is Robinson Stocks, and this is my stock pick of the week. This is part 2 of my 5-part series on the company BHP. This time we're going to look at the company's operations, which is really a look at how good a job the company does and how efficient they are at delivering their goods and services to the customer. I always start my analysis of a company's operations by looking at their gross margins. Gross margins are defined as revenues minus cost of goods sold. So what we're really looking at here is what pricing power this company has in terms of its goods and services. Now, generally speaking, as a Warren Buffett disciple, I tend to look for companies that have what's called a consumer monopoly. And I tend to avoid companies which are what we would call commodity companies. However, there are times when it makes sense to invest in a commodity company. For example, if you follow Warren Buffett, you know that he's been buying a lot of Occidental Petroleum. Obviously, oil is a commodity, but he believes that there's a shortage of oil production and he's trying to buy low-cost producers. And by doing that, you can profit very well from commodity companies if you've really studied them. So we're looking at BHP, which also is a commodity producer. They're one of the largest coal producers in the world, one of the largest copper producers in the world. And so what we're looking for is companies that are able to produce those commodities at a very aggressive price, which means they do a good job of controlling their operating costs. So you can see here that this company has generally, the green line is the desirable gross margins that I have for a company. So I want to see companies that have gross margins over 40%. If it's much below that, I start losing interest. This company has been above that number really every year since 2003. And more importantly, since 2015, it's been gradually improving. Now they're in the top 25% of companies in terms of gross margins. And for commodity producing company, that's very enticing. The next thing I look at is earnings per share. And I look at both the earnings total, which is the total amount of money they make. And I also look at earnings per share. Oftentimes a company is selling shares or is buying back shares, which will affect over time the earnings the value of the company that we have, because the same amount of earnings are being spread over less numbers of shares. So what you can see here is that, like most commodity businesses, there's peaks and valleys in terms of the income stream. It's not a straight line. It's certainly not straight up and to the right, like oftentimes we like with companies. But you can see since 2015, the earnings have been increasing basically every year. They're now significant in the range of $10 billion. That's very significant earnings. They've also grown the earnings per share at a rate that's even faster than that because they have been buying back shares. So when looking at a commodity company, you can't expect the earnings are going to go straight up. You do have to expect that there's going to be it's going to be cyclical. And I accept that, and I'm willing to buy the company because I believe the cycle is working in our favor right now. The next thing that I look at is net earnings as a percentage of revenues. Now, here you can see that this company has, I like to have companies that have net earnings better than 20% of revenues. And this company doesn't quite measure up to that. I believe that they're going to begin to reach that level. I think that we're in a good time for the coal that they produce is going to generate more and more profits and is going to drive them up to that level. However, I also believe that at this current level, this company is very profitable and pays a very good dividend. And as a result, every company doesn't have to reach my goal in every category. In fact, virtually no company does. The question is understanding the company enough to be willing to make a judgment call in some of these categories. And so while, again, the net earnings are not at my goal level as a percentage of revenue, I think that we're going in the right direction. And I think if we could even just stay here flat for a significant period of time, this would be a great investment. The other thing that I look at is I try and look at the net earnings and the revenues to see what's happening with them. And you can see that, again, since 2015, the revenues have been going up, and more importantly, the earnings have been going up in a pretty steady way. And so that is one of the things that gives me confidence that even though we're not reaching our goal in terms of net revenues as a percentage of earnings, net earnings as a percentage of revenues, I think when you look at the total picture, you'll see that this company's doing a pretty good job. The next thing that I look at in terms of a company's operating is how they handle what I call the 4 operating taxes. So there are a series of things that every company has to do to some degree. And if they do a good job with that, they're able to squeeze more profits out. And if they do a poor job, then obviously they generate less profits. So those 4 areas are what's called SG&A, which is selling and general administrative, plants and equipment, inventory, research and development, And then a fifth one, which is a little bit different, is the company's interest payment structure. So in these two slides, we can look at the company's selling and general administrative, and we can look at the company's plants and equipment. The selling and general administrative, they're basically in the top 10% of companies. They've been there for the last 3 or 4 years. It's been improving every year since 2015. Very, very strong. We're very excited about this. It actually shouldn't come as a surprise. When you produce commodities, you don't have to work as hard to sell them. The price fluctuates with the market, but there's typically always buyers for your product, which is one of the reasons why it would be low here. Conversely, this company's plants and equipment are extremely high. As you can imagine, that's almost exactly what you would expect. It's expensive to pull commodities out of the ground, right? So if you're digging up coal, you need dump trucks and you need heavy equipment. That equipment is very expensive. You also are doing a lot of refining, especially with copper. And as a result of that, you've got very expensive plants that you have to create. Also, these things tend to wear out over time and have to be replaced. So again, we expect that selling and general administrative would be low. We also expect the plants and equipment would be high. And that's what we're seeing here. We're able to live with both of those because they're basically pretty even, pretty flat, even though the revenues have been going up. So they're doing a good job of managing this in the context of their own business type. Inventories for this company are very low. Again, that's what you would expect with a mining company. The minute their inventory is pulled out of the ground, they're immediately shipping it off to get to customers. They're not really waiting, like a retail store would with stuff in inventory waiting for people to come and buy the shoe of that size, for example. So we always would expect relatively low inventory. We also see very little, in fact, virtually zero research and development. Again, research and development is centered around designing new products, and this company isn't doing that. While they are doing exploration, looking for new materials, that doesn't show up as much in R&D as it does in other places in the balance sheet. So in terms of the four commodities, the four basic, what I call operating taxes, the company is very low for selling general administrative. They're very low for inventory. They're zero for R&D, but they're very high for plants and equipment. We would expect all of those things, and when you add them all up, they're all within an acceptable range of what we would expect. And more importantly, cumulatively, they're actually in a very interesting range, very profitable range for the company. Interest payments are also a tax that a lot of companies have. It's a little different than the other four because it's a self-inflicted tax, right? The more money you borrow, the more interest you have to pay. And so we like companies that have no debt or very low debt because that keeps this cost in check. We also think the companies are borrowing a lot of money is a red flag for other phases of the business. And companies that have very little debt, that's a sign that the company is being run well. So what I like to see is a company spend no more than 15% of its operating income on interest expense, and this company is significantly below that. It has been every year except for 2015. So interest payments for this company are not really a problem, and again, one of the reasons why I like it. So the summary for the operations of this company, I look for gross margins that are at least 40%. The minimum I would really consider is gross margins of about 20%. BHP has managed to stay above 40% basically for the last 20 years. And that number has been increasing in terms of gross margins. Increasing is better. So the gross margins have been increasing and are now up over 60%. It's an amazing accomplishment for a non-tech company. It's one of the reasons why I really like this company and why I'm interested in it. Again, we talk about the issues with a mining company. Their products are commodities. So to some degree, the profits for a commodity company are beyond the control of the management. You can do a spectacular job pulling coal out of the ground, but if there's too much coal in the market or there's not enough demand, the value of your commodity is going to shrink and so are your profits. That's one of the reasons why I don't like commodity companies. They don't really have any pricing power. It's beyond their control. The last thing is in the last 20 years, the company's been in the top 25% of the companies in terms of income as a percentage of revenues. That's very, very good, especially for this kind of company. Selling and general administrative has been in the top 25% constantly. So that's very strong. And it recently that area has improved to the top 10% of companies. As I said, mining is a capital intensive business. You have all kinds of giant dump trucks and other equipment. And so as you would expect, plants and equipment are very, very high for this company relative to other companies. But we understand this, and in the context of the four taxes, they're low enough that we feel comfortable with this level of expense. Finally, R&D is zero and interest payments are very low. So when you add it all up, you say this company does a very good job in terms of operations, which on top of the other things that we're going to talk about are reasons why I recommend this company to investors. So that does it, a quick look at the operations for the company. Hopefully you've learned something. Hopefully you're starting to think this company, like I do, is a good investment. As I said, there will be 3 more parts to this review of this company. We'll look at the dividends, we'll look at the balance sheet, and we'll look at the wealth creation characteristics of the company. And hopefully after you've watched all 5 of those, you'll agree with me this company is something you should be adding to your portfolio.